Your brain did not evolve to invest. It evolved to keep you alive in a forest when a rustle in the bushes might be a snake or a predator, or worse, your neighbor Todd telling you about a new stock. Which is to say, you're wired to react quickly, not think patiently. Hello friends, this is Tyler Gardner welcoming you to another episode of your Money Guide on the Side, where it is my job to simplify what seems complex, add nuance to what seems simple, and learn from and alongside some of the brightest minds in money, finance, and investing. So let's get started and get you one step closer to where you need to be. Quick note before we get into it, June's pre-order incentive for my book, Real Wealth, is the most personal thing I've ever agreed to share. Pre-order in June and submit your receipt at tylergardner.com and you'll get an exclusive 3-episode audio series that will never appear on this feed. 3 pivotal moments in my own financial life. The humbling one, the embarrassing one, and the one that made me rethink everything. 3 episodes, 3 moments, tylergardner.com, pre-order, submit your receipt, get the episodes delivered digitally in early July, and receive every additional monthly incentive between now and the book's release on December 1st. And now, introducing today's episode, what I am lovingly referring to as the tyranny of the benchmark. For reasons I can no longer fully explain, though at the time they felt highly rational and quite urgent, I once spent a summer attempting to build a spreadsheet that could outsmart the entire US stock market. This was no small project. It involved dozens of tabs, thousands of data points, and at least one regrettable subscription to something called Alpha Wolf Trading Insights, which I will not be discussing further for legal and personal dignity reasons. But I had read the books, I had studied the charts, I had taught myself just enough statistics to be dangerous and just enough behavioral finance to develop a mildly superior attitude toward other people's investing mistakes. I had, in short, done everything right except the one thing that actually mattered, which was to stop what I was doing. And still, after all of that effort, after all of that self-belief, even after Alpha Wolf, my portfolio performed, more or less, exactly like a target date index retirement fund, only with more fees, way more anxiety, and considerably more self-delusion, which is when I began to suspect, with some reluctance, that perhaps I was not going to beat the stock market with consistency as Peter Lynch had told me that I might be able to. And if you're being honest with yourself right now, you probably won't either. This is not an indictment of your intelligence. It is not a comment on your work ethic or your innate ability to see patterns in candlestick charts that resemble extinct sea creatures. It is just an observation of reality, backed by mountains of evidence and delivered with genuine warmth and a gentle reminder that trying to outwit the market is like trying to outswim the tide. You can flail and splash and fight it all you want, but in the end, you're still getting pulled in the same direction as everyone else. Only now, you're exhausted and missing a sandal or two. Today, we're not just going to talk about why you won't beat the market, but we're going to talk about the very concept of beating the market and why it is one of the most expensive ideas in the history of personal finance, and why this is the part I really want you to hear. Matching the market is not mediocrity. It is a triumph. It is the smartest, calmest, most emotionally resilient thing you can do with your money over a lifetime. But first, I need to tell you about the worst thing that ever happened to the individual investor, which was also simultaneously the best thing. In 1975, a man named Jack Bogle had what was, in retrospect, one of the most genuinely revolutionary ideas in the history of finance. He launched the first index fund available to individual investors, a fund that didn't try to pick winners or beat the market, but simply owned the entire market at the lowest possible cost, and then it would let time do the rest. Now, if you listen to the podcast from a few weeks back, we know this was a profoundly simple idea, but we also know that it was mocked immediately. As I referenced, Fidelity's Edward Johnson called it un-American. Competitors called it Bogle's folly. One investment manager described it as a sure path to mediocrity. The financial press couldn't quite believe that anyone would seriously suggest that the right answer was to just own everything and stop trying. And as we know now looking back, or at least some of us know, Bogle was and continues to be right. Consistently, historically right. The data on this has been accumulating for over 50 years, and it points in one direction with the kind of unambiguous clarity that is genuinely rare in any field of human inquiry. So that was the best thing. And I know it's familiar, it might even feel repetitive to you, but I want to add some nuance, because in my mind, it was also the worst thing. Because the moment Bogle created an index fund to track the S&P 500, he accidentally, inadvertently, created a benchmark, a scoreboard, a standard against which every other investment, every other strategy, every other portfolio in America would henceforth be measured, whether that comparison was fair, relevant, or even coherent. Before the index fund, investors evaluated their portfolios the way you might evaluate a road trip. Did I get where I was going? Was the journey reasonable? Did I run out of gas? These were the only questions that mattered. After the index fund, investors evaluated their portfolios differently. Did I beat the S&P? Why didn't I beat the S&P? The S&P went up 12% last year, but my portfolio only went up 9%. I am, or my advisor is, apparently a failure. The S&P 500 became America's smug older brother, the one who got straight A's without trying, never needed a tutor, and somehow got into a better college than you despite spending every weekend watching sports. And now at every family gathering, like it or not, you're being compared to him by forces you cannot fully see or control. This is exactly what I mean by the tyranny of the benchmark. The index was created to liberate investors from the expensive, losing game of active portfolio management. But by giving investors a clear number to measure themselves against, it accidentally created a new game, a game of comparison that is financially destructive, psychologically corrosive, and almost completely divorced from whether your actual financial life is going well. Let's say your portfolio is up 9% in a year where inflation is 3%. You have grown your real wealth by 6%. You are, by any historical standard, doing extraordinarily well. But the S&P went up 12%, and so you feel like you lost. You didn't lose. You're comparing yourself to something that wasn't designed to be your personal benchmark, and then you're experiencing feelings about that gap. This is a trap. It's very elegant, it's a very modern trap, and almost everyone falls into it. So, here's the version of the question I'd like you to carry with you for the rest of this episode. What if the goal isn't to beat the market? What if the goal is to be the market, to own it, to mirror it, to let its long, messy, beautifully consistent trajectory carry you along for 40 years without all the fiddling, without all the fussing? Because breaking even with the market year after year for the rest of your investing life is not going to be a consolation prize. Trust me, it's going to be the prize itself. The actual prize that most investors, professional and retail alike, will never collect. Let me show you why. This episode is brought to you by Superpower. As many of you know, I've spent my entire adult life optimizing my financial health with a precision I have never once applied to my actual health. I track my portfolio, I know my expense ratios, but ask me what my cortisol levels are or whether my thyroid is functioning the way it should, no idea. My doctor told me I was fine at my last physical, I took his word for it and went home. That might have been about 5 years ago. And that is a strange way to manage the most important asset I own. Superpower treats your health the way a serious investor treats their portfolio, with real data, real tracking, and a real plan. A licensed professional comes to your home or you visit a lab nearby. One simple lab test gives you over 100 biomarkers: heart, liver, thyroid, hormones, metabolism, vitamins, environmental toxins, and your actual biological age. Not a snapshot, but a system that builds year after year so you can see real progress over time. Wealth means nothing without your health. This is where I'd start. Make this the year you stop guessing about your health with Superpower. For a limited time, our listeners get $20 off to unlock their new health intelligence. Head to superpower.com and use code Tyler for $20 off your membership. That's code Tyler, and after you sign up, they'll ask you how you heard about Superpower. Do me a favor and tell them your money guide on the side sent you to support the show. That's superpower.com, code Tyler. This episode is brought to you by Facet. A recent study of over 1,000 investors just dropped, and the numbers are uncomfortable enough that I want to walk through them quickly. 97% of people know they need a financial plan. Only 53% have one. 76% of those who do wish they had started sooner. And 66%, nearly 2/3, lack confidence in achieving their long-term goals entirely. Here's what that gap costs. People with a financial plan worry significantly less about saving enough, report higher life satisfaction, and describe their outlook as hopeful and prepared. But here's the number that bothers me most. 53% feel confident they'll save enough for retirement, and only 36% know how. That 17-point gap between hoping and knowing is where most self-directed plans fall apart. The top reasons people don't have a plan: too expensive, don't have enough assets, all perception problems. None of them are real reasons to stay unplanned. If any of this resonates with you, you're not alone, and Facet may be your answer. Flat annual membership fee, no commissions, no minimums, one team of dedicated CFP professionals who build a plan around your actual life, not just your portfolio. Because this isn't just about having a plan, it's about creating a life worth planning for. Visit facet.com/Tyler to book an intro call today. That's facet.com/Tyler. Facet is an SEC registered investment advisor. This is not advice. All opinions are my own and not a guarantee of a similar outcome. I'm not a member of Facet. I have an incentive to endorse Facet, as I have an ongoing fee-based contract for cash compensation, as well as a percentage of equity in Facet based on this endorsement. The study was conducted by Morgan Stanley in July 2025. Section 1. Why beating the market defies logic. I want to start with a thought experiment. Suppose I offer you a deal. You hand me $100 today, and in exchange, I will give you, on average, $7 a year. Maybe a little more, maybe a little less, depending on what the economy decides to do on any given day. But over time, on average, 7% of the principal. You don't have to work for it. You don't have to monitor it. You don't even have to think about it. All I need is for you to be patient. In finance, this is considered a remarkable bargain. In any other area of life, it would feel like a scam so good you'd be too embarrassed to tell your friends about it. And yet, instead of celebrating that 7% as the miracle it actually is, our first instinct is to wonder if we can get 8 or 9, or maybe something a little flashier, something that could be featured in Forbes under a headline like "How I Turned $100 into $47,000 while sitting in a sauna and day trading Solana." That's the psychology of the modern investor. We are offered something historically generous, absurdly convenient, and our first instinct is to wonder if it is somehow not enough. This idea that your investments shouldn't just grow, but should outperform, is not ancient wisdom. It is not particularly wise at all. It is mostly a byproduct of marketing, of benchmarks, and of a financial media ecosystem that exists to generate content. And content requires drama, and drama requires the possibility of, wait for it, winning and losing. That's why the benchmark was called un-American, because you just became average. The earliest index funds weren't designed to be scored like a football game. They were just reference points, instruments to help investors understand what the broad market was doing, not something to beat. But once we started comparing everything to the S&P or the Dow or the NASDAQ, we rewrote the entire goal of investing. It wasn't enough to just grow your money. Now you had to win. And this is where it all starts to unravel. Because if the market is a composite of everyone's best guesses, the collective intelligence of economists, analysts, algorithms, and investors from around the globe, then beating it isn't just hard, it is mathematically, let's say, rare. To beat the market, someone else must underperform. For every person who gets above average returns, someone else must get below average returns. That is not a policy position, it's basic arithmetic. And if everyone is trying to outperform simultaneously, you're not betting against the market. You are the market. Every trade you make, every prediction you act on, every hunch you follow becomes part of the pricing mechanism that sets the very standard you're trying to outrun. It's like entering a spelling bee where everyone writes the dictionary as they go. The irony's rich. Simply matching the market puts you ahead of most investors. More than 80%, we know this, of actively managed funds run by professional investors with resources, infrastructure, and teams of analysts underperform the benchmark over long periods. Individual investors do even worse than that, not because they're stupid, but because they're human. They get anxious, they chase trends, they try to time entries and exits, and in doing so, they systematically subtract from the returns they were trying to beat. Yet, for some reason, we keep playing the same game, eyes locked on the S&P like it's a personal nemesis. And here's the other version of this problem that nobody talks about. Even if you have a perfectly designed portfolio, international exposure, bonds, real estate, cash position, you will still find yourself feeling bad when the S&P goes up 12% and your diversified portfolio goes up 9%. But, and I mentioned this about a year ago, but I haven't since, so it's worth the reminder, that is not a fair comparison. You can't do that. That is comparing a fruit salad to an apple and feeling like a failure because your salad doesn't look like the thing you picked off the tree. The truth is that most diversified portfolios are not designed to beat a 100% stock index. They're designed to survive the volatility. They're designed to grow steadily while protecting you from the catastrophic years that wipe out people who were only holding one things. Bonds, they can help support you. International exposure, that can be some basic insurance for domestic issues. And cash is the thing that lets you sleep at night and pay the plumber when your pipes explode at 2 a.m., which we all know if they haven't yet, they will. And yet we struggle to accept this because beating the market has become this proxy for intelligence, for success, for identity. We don't want to be average. We want to be exceptional. We want to feel like we're smarter than the crowd, even though the crowd in aggregate is almost always smarter than we are individually as it pertains to the market. So here's the radical thought I want to plant before we move on. What if average in and of itself is the win? What if the S&P return captured cheaply and held patiently is not the floor of acceptable performance, but the very ceiling of achievable performance for most investors over most time horizons? Because that is what the data continues to show. And the best part, you don't have to do anything special to get it. You just have to stop trying to be special. Number 2, you're up against giants. Let's pretend, just for a moment, that you still believe you can beat the market. Maybe you've convinced yourself that you have a gut instinct or a knack for spotting trends or some special talent for parsing earnings reports in a way that Bloomberg's army of analysts somehow missed. You got a feeling, a thesis, an edge. You're one of the people who goes to the casino and don't worry, you've got a system. Okay, fair enough. I'll play along. But if you're going to play this game, if you're really going to try to outmaneuver one of the most efficient systems in human history, you should know who you're actually up against. And I don't mean your cousin Doug, who brags about his Coinbase gains at Thanksgiving and still believes Dogecoin is early. I mean the actual players, the institutions, the hedge funds, the algorithmic traders, the pension funds with 7 floors of staff and a risk model for every conceivable weather pattern and presidential tweet. These are firms that spend millions of dollars per year, not on the investments themselves, but on gaining speed, information, and access over you. They hire physicists to design trading algorithms that can adjust strategies in microseconds. They lay fiber optic cables under the Atlantic Ocean so their trades can reach London 3 milliseconds faster than their competitors. They install microwave towers between Chicago and New York because the curvature of the Earth makes light travel faster through air than through glass, and 3 milliseconds is worth millions of dollars in the right market. None of that is a metaphor. These are actual strategies deployed by actual firms right now. Meanwhile, you're on your couch, in sweatpants. You're watching CNBC with the sound off while half-heartedly reading an article about AI stocks on your phone, which is also alerting you that your DoorDash order is 8 minutes late. But you've got a feeling about semiconductors. It's not a fair fight. It was never a fair fight. And the sooner you make peace with this, the sooner you can redirect your energy towards something you can actually control, like keeping costs down and investing in broad index funds. Because even if you are smart, and let's be genuinely generous and assume you are dialed in, even if you are well-read, disciplined, and have access to real-time news and financial statements, you're still fundamentally disadvantaged because you're not operating in a vacuum. Every single piece of public information you act on has already been acted on. Every intuition you have about a stock being undervalued is, statistically speaking, a hunch that hundreds of professionals have already priced in, dissected, and arbitraged into irrelevance. So it's not that you're wrong, it's that you're late, or at the very least, ever so slightly later. Markets move not when news breaks, but when the interpretation of that news shifts the expectations of people with real money. And those people don't spend their mornings on Reddit. They're rarely tweeting, they're not waiting for the weekend to do some research. They are placing bets in real time, armed with tools you don't have and incentives you don't understand. And here's the detail that I find most clarifying. Those giants don't even win reliably. The majority of actively managed hedge funds underperform a basic market index, even with the billion-dollar budgets and Olympians doing their math. The edge is so slim and the cost of chasing it so high that it frequently cancels itself out. You're trying to outrun a group of professionals who cannot and do not reliably outrun each other, which raises a very honest question. If these institutions, with their microwave towers, their fiber optic cables, and their PhDs in physics, are mostly spinning their wheels trying to stay even with an index net fees, what exactly do you think you're going to find? A secret? A signal no one else has seen? A pattern that thousands of algorithms have missed but that became visible to you on a Wednesday afternoon between conference calls? And trust me, I speak from experience and I preach with empathy because I understand the appeal. I genuinely do. Remember that summer that I spent reading Alpha Wolf. I know what it feels like to believe you are the exception. It is an extremely pleasant feeling right up until it isn't. Because there are no secret handshakes left. There are no magic stock tips that haven't already been dissected and digested into the price. What remains, more often than not, is a boatload of noise, a whisper of advantage that vanishes the moment it appears. By the time you buy, it's gone. By the time you react, you are the exit liquidity for someone else's better strategy. This is a competition you will not win, and the scoreboard, I promise you, is already set against you. This episode is brought to you by Copilot Money. I have a group chat with 4 of my closest friends from my finance days. Between us, decades of managing other people's money, multiple licenses, and an embarrassing amount of opinions about actively managed funds. These are not people who download budgeting apps. These are people who tend to mock budgeting apps. And yet, every single one of them uses Copilot Money. The group text now contains, between bond market commentary and Bills game updates, sincere love letters to a finance app. One texted last week, "I finally feel like my financial life is in one place." That's from a guy who manages 8-figure portfolios. Here's why people who actually know money land here. It tracks spending, net worth, investments, savings goals, and budgets in one dashboard. And it's beautiful to look at, which shouldn't matter, but does when you're building a habit. It auto-categorizes transactions, it tracks subscriptions, so you'll finally find the streaming service you forgot about and the gym membership you've been emotionally lying to yourself about since February. It works across iPhone, iPad, Mac, and web. And, best part, they don't sell your data. It's the only personal finance app to win an Apple Editor's Choice Award, an Apple Design Awards finalist, and it has 4.8 stars from over 28,000 reviews. So go to copilot.money/Tyler, use code Tyler2, that's Tyler and the number 2, for 2 free months. That's copilot.money/Tyler. This episode is brought to you by Fabric by Gerber Life. I have a wife, a business, a book coming out, and a bloodhound with expensive taste in veterinary care. If something happened to me tomorrow, the financial picture for the people I love would get complicated very quickly, which is exactly why most of us don't think about this. We put it off and another year goes by. Life insurance isn't something you buy for yourself. You buy it for the people who depend on you, so they're not scrambling in an already devastating moment. Fabric by Gerber Life is term life insurance you can get done today, all online, on your schedule, right from your couch. You could be covered in under 10 minutes, often with no health exam required. If you have life insurance through work, that's great, but it often disappears the moment you change jobs. Fabric by Gerber Life follows you wherever you go. Up to $1 million in coverage for less than $1 a day, 30-day money-back guarantee, and nearly 2,000 five-star reviews on Trustpilot. Join the thousands of parents who trust Fabric to help protect their family. Apply today in just minutes at meetfabric.com/Tyler, meetfabric.com/Tyler, and use my link so they know I sent you. meetfabric.com/Tyler. Policies issued by Western Southern Life Assurance Company, not available in certain states. Prices subject to underwriting and health questions. Number 3. Beyond all of that, you, unfortunately, are and always will be your own worst enemy as it pertains to investing. If it weren't bad enough that you're competing against supercomputers and former chess prodigies with fiber optic cables under the ocean, the real reason you will never beat the market is this. Even if you could somehow keep up with them, even if you could pick the right stocks, interpret the data correctly, time the trades, and avoid the fees, you would still lose. Why? Because you are a human being. And human beings, despite their extraordinary capacity for language and love and inventing the air fryer, are statistically terrible investors. You might believe you're the exception. You are logical, you are thoughtful, you're rational. You might even take pride in how unemotional you are about money, as if you're some kind of spreadsheet with a slight pulse. But behavioral economists, and also, frankly, your brokerage history, would like to politely disagree. We are, by design, riddled with cognitive biases, not as a moral failing, as a survival feature. Your brain did not evolve to invest. It evolved to keep you alive in a forest when a rustle in the bushes might be a snake or a predator, or worse, your neighbor Todd telling you about a new stock. Which is to say, you're wired to react quickly, not think patiently. You are built to fear loss more than you value gain, and you are exceptionally talented at constructing elaborate post hoc narratives to justify decisions that you already made on impulse. Let's quickly and briefly discover a few of our biggest biases that make us terrible investors. We'll start with the classic, and in my 20s and 30s, I was so guilty of this one, it's not even funny. Overconfidence. The same instinct that leads 80% of people to believe they're above average drivers, which is mathematically adorable. I love that statistic. It is the most human statistic in existence. also leads most retail investors to believe they're above average stock pickers. You make one good trade. Maybe you bought something before it doubled or sold something at exactly the right moment, and suddenly you believe you're the one. You're clairvoyant. You weren't lucky, you tell yourself. You were right. You had a feeling, a thesis, a moment of genuine analytical brilliance. Never mind the 29,000 other trades that went sideways. Never mind the fact that your thesis came from a guy named Derek on YouTube whose credentials consist of a whiteboard, a ring light, and a confidence that is entirely disconnected from his track record. You focus on the win. You build a story around it. You inflate your confidence like a souffle, unaware that it is hollow and likely to collapse under the slightest jolt of volatility. Next comes recency bias. That is when you assume that what just happened will continue happening. Markets go up for a few months, you feel invincible. You increase your exposure. You start throwing around phrases like risk-adjusted alpha in conversations with your barista. Or the market drops and you're suddenly convinced we are on the precipice of total collapse. You stop investing, you hoard cash, you rewatch The Big Short like it's prophecy, and begin researching countries with favorable extradition treaties. We don't predict the future. We extend the present, which brings us to the most insidious bias of all that we have talked about repeatedly, loss aversion. It's documented finding pioneered by Kahneman and Tversky, who we've discussed in the retirement episodes, that losing $1 feels approximately twice as bad as gaining $1 feels good. And if you don't believe it, consider how you reacted the last time your portfolio dropped 5%. Most of us did not say, it's part of the game. You said, what's happening? Should I sell? Should I buy gold? Is this 2008? Should I call someone? Who do I call? Does anyone even know what's happening? You didn't just feel the loss. You spiraled into a feedback loop of doubt, fear, and search terms like best countries to move to when the dollar collapses. The problem isn't the drop, because markets drop. We know that. They've always dropped, and they've recovered from every single drop in the history of American markets, including the ones that felt at the time like they wouldn't. The problem is how you respond to the drop. We say we're long-term investors until the short term makes us sweat. Then we become short-term investors with long-term regrets. And we haven't even gotten to one of my favorites, confirmation bias, or anchoring, or the endowment effect. Look that one up. Or herd behavior, or the perennial favorite, market timing. The seductive idea that we can predict when to be in and out of the market, despite decades of data showing that missing just 10 of the best market days in a given decade, 10 days out of 2,500, cuts your total return roughly in half. 10 days that you were out of the market, you could miss those by sleeping in. But we still try. We tweak. We react. We fiddle with the portfolio like the market is a stereo and we're trying to get better sound on a playlist. And every time we fiddle, just know this, every buy, every sell, every adjustment, we pay a transaction cost, a spread, a fee. So even when we're right, we're starting from behind. Our job isn't just to beat the market. It's to beat the market after fees. And as anyone who has ever paid an advisor 1% of assets annually will tell you, that 1% over 30 years is not 1%. It is after the compounding effect of what that money would have been worth if it hadn't been taken out each year, something closer to 20 to 30% of your final portfolio value. 1% feels small. Compounding makes it ridiculously large. So the whole game, the whole beautiful, counterintuitive, deeply unsatisfying game of long-term investing comes down to one word. Stop. Maybe a couple more words. Stay. Don't touch it. Go do something else. Let the machine do what the machine does. If you can do that, if you can survive your own psychology long enough to let compounding do what compounding does, you will already be ahead of the vast majority of investors, retail and professional alike. And you will finally understand the simplest, most overlooked truth in all of finance. Success doesn't come from brilliance. Success comes from staying out of your own way and being average. To wrap this all up, we've now arrived at what I hope is a clear truth at the center of this very noisy pursuit. After all the algorithms and the biases, after the stock tips whispered like secrets across dinner tables, after the graphs and the grand theories and the moments of sheer delusional overconfidence, we find that the great secret of investing is almost insultingly simple, and I believe it always will be. Don't outsmart the market. Outsmart yourself. The trick is not brilliance, it is restraint. And the longer I've been in this world, the more portfolios I have reviewed, the more investors I have talked to, the more time I have spent with actual data, the more I believe that true investing mastery looks less like expertise and more like humility practiced consistently over time. I want to repeat that. I think true investing mastery looks less like expertise and more like humility practiced consistently over time. And humility is hard to hold on to because the world keeps nudging you to perform. You're surrounded by hot takes and highlight reels, by friends who swear they got in early, by media that treats long-term index investing as background noise rather than a life-altering strategy. Nobody makes a Netflix documentary about the person who bought VTI in 2003, reinvested the dividends, and never looked at it again. That story doesn't have drama. It doesn't have a third act. It's just a person several decades later with an extraordinary amount of money and a completely unremarkable investing story. But that's the goal. The unremarkable story with the remarkable outcome. Let's go back to Jack Bogle for one more minute. The man who created the index fund, who was told he was building a monument to mediocrity, who watched the financial industry mock him for a decade before the data became so overwhelming that even his critics had to concede. He spent the rest of his life saying the same thing in 100 different ways to anyone who would listen. Don't just do something, stand there. The markets will do what the market does. It will go up because it always has. It will drop periodically because it always does. And your one job, your only real job as an investor is to own it cheaply. You can control that. Hold it patiently. You can control that. And resist with every fiber of your being the entirely natural human impulse to do something more clever than your neighbor. And yes, you can control that. The S&P 500 is not your nemesis. It's not your smug older brother. It is not a standard you're failing to meet. It is a slow, reliable, historically consistent boat that goes in one direction over time. And all I implore you to try to do this week is stay on it. And as always, hope this gives you something to think about throughout the week ahead. Thanks for tuning in to your Money Guide on the Side. If you enjoyed today's episode, be sure to visit my website at tylergardner.com for even more helpful resources and insights. And if you are interested in receiving some quick and actionable guidance each week, don't forget to sign up for my weekly newsletter, where each Sunday I share 3 actionable financial ideas to help you take control of your money and investments. You can find the sign-up link on my website, tylergardner.com, or on any of my socials at socialcapofficial. Until next time, I'm Tyler Gardner, your money guide on the side, and I truly hope this episode got you one step closer to where you need to be.